In this video, we uncover why downside protection costs more than upside potential. If you look at an option chain for the S&P 500, you will almost always notice a distinct pattern. Out-of-the-money puts trade at a higher implied volatility than equidistant out-of-the-money calls. This phenomenon is known as volatility skew, or the volatility smirk. It implies that the market assigns a higher probability, or at least a higher price, to a significant market crash than to a massive market rally. The primary driver of this skew is the crash risk premium. Institutional investors, like pension funds and mutual funds, are naturally long the market. Their greatest fear is a rapid, catastrophic decline. To hedge this risk, they buy OTM puts as portfolio insurance. This persistent, structural demand for downside protection drives up the premiums of these options, inflating their implied volatility relative to calls. This wasn't always the case. Before the crash of Black Monday in October 1987, implied volatility was relatively flat across all strikes, assuming a normal distribution of returns. However, the 1987 crash taught the market that fat tail events, moves of 20% or more in a single day, are more likely than standard models predict. Since then, market makers permanently price in this skew to account for the asymmetric panic of a sell-off. Mechanically, remember that implied volatility is a variable derived from the options market price. When panic or hedging demand drives the price of a put option higher, and the stock price and time to expiration remain constant, the pricing model must increase the variable to justify that higher market price. Therefore, high demand for puts mathematically equals higher implied volatility. For us as traders, this skew presents both risks and opportunities. It means buying OTM puts for speculation is statistically expensive because you are paying for that fear premium. Conversely, strategies like put credit spreads allow you to sell that expensive volatility to others. Understanding skew helps you avoid overpaying for protection and identify where the market is pricing in the most fear. Thanks for watching, and see you in the next episode on term structure.